Okay. Welcome to everyone. This is our presentation on an investment strategy combined with the help of the artificial intelligence. Our group is composed by Antonio Mucciaccia, Filippo Lollobrigida, Guido Pieralli, and me, Giulia Caridi. Okay. Okay. The first thing that we decided to take into account before considering the different investment strategies was to actually focus on the current macroeconomic environment. We analyzed a few indicators that we consider to be relevant, and the reason why we believe them to be relevant for our investment strategy. And basically, our conclusion is that the US economy is probably heading for a recession. So are we really heading for a recession? First of all, this chart is showing the yield curve for the United States as of June 2023. Okay, the particular thing in this chart is that the trend is downward. So the yield curve is downward sloping, and an inverted yield curve basically is unusual because yield curves are usually upward sloping. This downward slope in the yield curve is due to the fact that investors expect interest rates to be lower tomorrow than they are today. And basically, this situation basically foresees an imminent recession. And usually, economists consider an inverted yield curve as a predictor of an imminent recession. So this is the first reason why we expect the economy to slow down. Moving on to the next graph. Basically, in this chart, we can see the difference between the yields for a 10-year and a 2-year treasury note. Basically, when this difference is positive, which is something that can be observed when the blue line is above the black line, it means that basically the investors are demanding a higher yield for longer term bonds. However, where you see the pink arrows, we basically have a situation in which this spread is negative. And this negative spread is seen as a sign of economic weakness, and it suggests that investors are worried about the future of the economy. Negative 10 to 2 spread has predicted every recession since 1955 to 2018. Basically with a 6 to 24 months 6 to 24 months before the recession actually began, and we can consider it as a far leading indicator. Then we can move to the next slide, and basically we asked Bard, our artificial intelligence, one of the tools we used to compose our investment strategy, and we basically asked Bard his take on a possible recession. And basically he replied to us that the risk of a recession in the United States is rising, although it's too early to say for sure whether it will happen or not, but like there are many factors that affect the valuation in that sense, including the war in Ukraine. Of course, Bard's answer is not 100% satisfactory, but it pointed out in the right direction. And the only advice that we can take on this is to invest in assets that are less sensitive to economic downturns. This next chart shows basically the increasing trend in the aging population in the United States, and we can observe how population is aging in recent years. So basically in the last 10 years, population in the United States has become older and older, and our focus was on highlighting the fact that an older population will demand more healthcare services, treatments for chronic diseases, long-term care facilities, and specialized healthcare for the elderly. And basically, addressing the needs of an aging population requires the development of a sustainable healthcare system and supporting social policy. And basically, can be an anticipation of why we decided to move in the direction in which we actually moved. And now I will leave the floor to my colleague, to my colleagues.
So thank you, Giulia. And the second aspect that we would cover is the investor profile, important for a better understanding of our investment strategy. In this slide highlights an investor profile characterized by a 15 years time horizon, moderate risk aversion, a willingness to accept some volatility, and an expectation of double-digit return. So let's explore how this investor profile can inform investment decision and strategies. With a 15 years time horizon, the investor has a long-term outlook. These allow for a potential higher tolerance for market fluctuation and the ability to benefit from compounding growth over time. A longer time horizon opens up opportunities to invest in growth-oriented assets and take advantages of market trends. The investor moderate risk aversion suggests a balanced approach to risk and return. While not seeking excessive return, this investor recognizes the potential for higher return and is willing to accept some volatility in pursuit of their financial goals. So then we have the volatility. What about the volatility? The investor acknowledges the potential for short-term market fluctuation. And for the last aspect of double-digit returns, the investor expectation reflect a desire for above average growth. So now the third argument that we would cover is the picking process done for the ETF. So ETF picking process offers several advantages for investor. Firstly, the ETFs allow for a greater level of diversification compared to investing in a single stock. By holding a basket of securities within an ETF, investor can spread their risk across multiple companies and industry, reducing the impact of individual stock performance on the overall portfolio. Secondly, ETFs typically have lower cost compared to traditional mutual funds. With lower expense ratio and fewer management fees, investor can benefit from the cost of the cost-efficient investment options while still gaining exposure to a diversified set of assets. Overall, the ETF picking process offers the opportunities to achieve diversification, cost efficiency, and exposure to sectors like energy that have shown resilience in challenging economic times. So the ETF picking process offers a range of benefits, particularly when considering FENI as an investment option. So firstly, FENI stands out for its low cost with an expense ratio of just 0.08%, making it a cost-effective choice compared to other ETFs. This lower expense ratio can enhance overall returns for investors. The second one is something about diversification, and which is another key advantage for FENI. By tracking the MSCI USA Energy Index, FENI provides exposure to a broad range of energy companies, allowing investors to spread their risk across the sector and potentially capture the opportunities for growth. Furthermore, the energy sector has demonstrated resilience during recession, making it an attractive option for investor seeking stability in uncertain economic times. In addition to potential capital approach, Feni offers different income with a yield of 3.83%, surpassing the average yield of the Standard & Poor's 500. This feature can provide investor with a consistent stream of income from their investment. So Feni also boasts liquidity, ensuring ease of trading in the ETF. Its transparent nature allows investor to easily monitor its holding and performance. So lastly, Feni's passively managed approach offer tax efficiency by avoiding capital gains taxes on dividend distribution. So considering the combination of low cost, diversification, growth potential, resilience, dividend income and liquidity, transparency and tax efficiency, Feni represents a compelling option for investors looking to incorporate the energy sector in their portfolio. So now let's dive into the key metrics of characteristic of Feni in this comparison chart, providing valuable insights into the ETF's performance and composition. By assessing these metrics, investor can gain a comprehensive understanding of Feni performance, risk profile, and composition. For this reason, we choose Feni even if it has relatively low volumes of trade, because we do not want to trading, but rather holding the ETF for a mid-long run. So we prefer lower cost instead of higher liquidity. So as final check, let's take a closer look at the top holdings of the Feni's ETF. So these holdings, all well-respected and reputable companies, represent the largest position within the fund and provide valuable insights into the composition of the ETF. Now I pass the floor to Filippo for the next part.
Okay, now I'll discuss about the stock picking process of our portfolio, based on the assumption that of our microenvironment analysis, which led to the conclusion of a possible recession scenario. We base our stock picking process on the assumption of a recession. So the first question that we asked to our AI was like, hey, Bard, which feature a stock should own to perform well during a recession? So the feature that Bard provided to us were the strong balance sheet. That means that the company has a lot of cash on hand, a low debt on the other end, a stable revenue stream, a low PE ratio, and a dividend-paying stock. So now let's move to the next slide. We ask a question which follow the previous one, is that always based on our microenvironment analysis, which as Giulia said before, is that there is a trend of aging in population. So based on that assumption, we choose the healthcare sector as a sector to pick our stock in. So since the healthcare sector is a recession-resistant sector, so the demand for healthcare services does not decline as much as demand for other goods and services during a recession. So then the healthcare sector is growing. So the global healthcare market is expected to grow at a compound annual growth rate of 5.3% from 2022 to 2028. And since this growth is being driven by a number of factors, such as as we said before, the aging population, the rising of chronic disease rates, and technological advances. So the second question that we asked to our AI Bard is to provide a stock on the healthcare sector that satisfy the criteria previously mentioned, and so that will perform well in a recession scenario. So the stock and the firms that Bard provide to us was the United Health Group, the Johnson & Johnson, Pfizer, Abbott Laboratories, and Medtronic. So let's move on the next slide. So the third question that we asked to our AI was, act as you are the most successful financial planner, which stock between the one previously provided would you pick and why? So between all of that, our AI choose United Health Group, since is a leading health insurer with a strong track record of profitability. And then the motivation that our AI gives to us is that the healthcare industry is growing, and United Health Group is well positioned to benefit from this growth. Then another motivation is that United Health Group is a good value for investor, since the company stock is currently trading at a discount to its intrinsic value. This means that investors have the opportunity to buy shares of United Health Group at a good price. UNH, so United Health Group, is better than its competitors since it has a number of advantages, such as a larger and more diversified customer base, a stronger financial position, a more innovative product portfolio, and a more efficient operating model. Overall, UNH is a well-positioned healthcare company that is poised to grow and outperform its competitor during a recession. Now, moving on to the next slide, we simply make a summary of all the positive aspect of UNH, United Health Group. First of all, is a leading healthcare company. Then UNH is a good value stock. Now let's remember that value stock is a stock that has a low price to earning ratio, an high dividend yield, and a strong financial performance. So another motivation that we take into consideration in our stock picking process is that the UNH stock is trading below its intrinsic value, according to many analysts such as Guru Focus, Yahoo Finance, and Simply Wall Street. Then it has a strong dividend yield. It has a strong track record for growth and profitability. And then, first of all, as our microenvironment analysis and the trend, we take into consideration also the trend of aging population will lead to the increase in the need for healthcare services. Then, moving on to the next slide, we make a comparison chart between our stock UNH and the comparables, such as we take into consideration ELB, which is Elevance Health Inc., the Senior Group, CI, and HUM, which is the Humana Inc. So we in the first comparison chart, we take into account the price, the market cap, the enterprise value, the revenue, EBITDA, and EPS. So first, since the price reflects its current market value, and so as we can see, higher price means it is more competitive than others. So we can see from this comparison chart that the UNH stock has a higher price, market cap, enterprise value, revenue, and EBITDA. Like all of these we can gain a deeper understanding of the financial position of the stock and the performance within the healthcare sector. And so we can understand that and we can see that the company is a large and well established business with a strong track record of profitability. Then, so the company is in a rapidly growing industry with demand for its product or services. then the company is perceived as a leader in its industry and is therefore valued highly by investor. And the company is trading at a premium to its intrinsic value to this speculation. So these are all the deeper understanding that we can gain from the this comparison chart and from the analysis of the price, market cap, enterprise value, revenue, and EBITDA. Next, let's move on to the next slide, which is another comparison chart. But here we analyze the P ratio, the price to book value ratio, the dividend yield, the payout ratio, the enterprise value on EBITDA ratio, and the ROE. So first of all, higher P ratio suggests that the market has a higher expectation for future growth. So let's make a brief analysis of each ratio. Then analyzing the UNH price to book value ratio, we can provide insight to its valuation relative to its underlying assets. Now, and then the dividend yield represents the annual dividend payment relative to its stock price. Then examining the UNH dividend yield can help to evaluate its income generating potential. Then we analyze the payout ratio. The payout ratio measures the proportion of earnings distributed as dividends. We focus on that because this can be a positive sign for investors who are looking for income, especially in a recession scenario. Then, as we can see, the UNH stock has the higher enterprise value on EBITDA, so which is a valuation metric that compares the enterprise value to its EBITDA. So it helps assess the company's profitability relative to its total value. And evaluating the UNH, evaluating this ratio, this can provide insight to its operating performance and valuation. So in this case, this can be a sign that the market is expecting strong future earnings growth from the company. And lastly, we have our ROE that measures its profitability relative to the shareholder equity. And it simply indicates how efficiently the company generates profit using shareholder investment. And as we can see, UNH stock has the higher ROE, and this can be a sign of a well-managed company that using its capital efficiently. But it can also mean that the company is taking a lot of risk. Now I'll leave the floor to my colleague.
Hi everyone, I will take you through the next part of the presentation regarding the optimization of our portfolio. So we decided to minimize the variance of our portfolio since our investor profile is doesn't want to go through excess volatility. And in order to avoid excessive risk, our portfolio is optimized to minimize volatility. We know that during a recession, stocks and ETFs are more likely to perform poorly, and this is also one of the reasons why we chose to minimize the variance of our portfolio. Before going to the portfolio optimization, as a further measure, we want to we asked the Perplexity AI, that is another artificial intelligence, to confirm our portfolio choice. So we asked if he thought that our portfolio made by UNH stock and Fannie ETF is likely to minimize the variance during a recession. Perplexity gave us a positive answer, saying that both UNH and Fannie may be able to minimize variance during a recession. Since UNH is a fast-growing recession-resistant company with a very solid balance sheet. And also it explained how it is expected to grow 12% in a recession, grew 12% during the pandemic, and only shrank 8.5% during the Great Financial Crisis. This makes UNH as close to a recession-proof business as exists. Fanny is an energy ETF that tracks a basket of securities, and we know that this poses a great advantage both for diversification and also because the energy sector is thought to be resilient during recessions. We also asked how Fanny performed during the most recent recessions. Unfortunately, Perplexity didn't have enough data to answer, but it told us that Fanny has done well in the past few years due to tremendous rally in energy stocks after the COVID pandemic and the war in Ukraine. Additionally, we know that Fanny hit a 52-week high on June 22nd, 2023, and it has the highest total returns compared to its peer funds. So now we go through the optimization part. To optimize our portfolio, minimizing the variance, we asked ChatGPT to provide us with a code that, given the annual returns of the two securities as input, would give us as an output the optimal weights of our portfolio. So you can see the prompt. We gave the returns of the two stocks in an Excel format. This is a screenshot of the Python code that we use to optimize our portfolio, and we can see that X is equal to 0.89, which means that the weight given to UNH stock is about 89%, with the remaining 11% pertaining to Fanny ETF. This is a pie chart showing the optimal portfolio allocation that I just told. So this almost concludes our presentation, and basically the point of our presentation was to see was mainly an experiment since we wanted to see what contributions AI could give to portfolio construction. Of course, we know that AI is still in a pretty early stage, and it needs some refining also ourselves during this experiment. We encountered some difficulties as sometimes data provided by Bard or Perplexity didn't perfectly match with what we knew from, say, Yahoo Finance or whatever other finance data provider. In the end, of course, we know that in the next few years will provide us with the relevant information to assess how this portfolio that was built, as we said, with the contributions of AI will perform. In the meantime, we can leave you with this, and that is a backtest of this portfolio that we just illustrated, that is 89% in UNH and 11% in Fanny. We see that starting from 2014, the portfolio, if we had acquired this portfolio in 2014, we would have enjoyed significant gains. And this is, of course, we know that the past is not a perfect indicator for future, but again, still, it may give us some relevant info and insights. This concludes our presentation, and we would like to thank you for your time and attention.